Welcome everyone to Macro Matters. This is our bi-weekly conversation about the macro events that matter for our members in the finance industry. Before I go on, I am going to remember to let you know that there is a YouTube video for those that listen to this on your podcast apps. We sometimes include some slides here. You do have us as talking heads there, which is always helpful and entertaining. And if you wonder the kind of things, the slides that we're talking about, just check out our YouTube channel. You go into YouTube and you can search CFA Society Chicago and find us easily there. Today is April 20, the famous 420. 2022, and my name is Lotta Moberg of the Dynamic Allocation Strategist team at William Blair, and with me, as always, I have Rich Excell and Tony Zhang, who are both of the Geese College of Business at University of Illinois. Welcome, guys.
Hello, Lotta. How you doing? Hey, Tony. Good to see you guys again.
Hey, Lotta. Rich. Yes, nice to get together.
It's always so nice to get together. And we wanted to tackle today this thorny question about duration. Has the duration bubble burst? And in order to answer that question, we really need to understand duration a little bit deeper level. If anyone started to study for the CFA exam or have studied for the CFA exam, you may remember duration as this thing that we read a lot about in the fixed income part of any financial textbook. It usually comes in when we're talking about bonds. And we could, however, think about duration as this broader concept in basically the universe as a whole. Now, because our universe is the finance industry, we tend to think about two main contracts here. And we're not going to make it more complicated than going beyond the contract of a fixed income contract and an equity contract. Both of them actually have duration. And you might not think about the duration that we actually have in the equity space. We want to, because this is a little bit harder one, we want to dig in a little bit deeper into that one. So what is duration? A duration you generally think of, right, as the average horizon of the cash flows that you get of a contract. So when you have your bond, right, it's going to be like this coupon, $5, $5, $5, and there's going to be like $105 in the end if it was a 5% coupon. So we're kind of familiar with that model. It's pretty easy to model out. How do we think about this in equity space? We do want to understand that. And that's a way to think about the cash flow. Now, the other way to think about duration, right, is the sensitivity to interest rates. That's another way. When you actually do the math, you realize that if I discount these cash flows in this perfect bond world, the duration doesn't matter how you define the duration. Whether it's the average horizon or whether it's sensitivity to interest rate, they're going to be the same number. It's not like one bond is going to have two different duration numbers. Equities, it's going to be the same thing, right? But you have to start wondering, right? And I'm going to turn this over to Tony because he's the more of the expert here. So I'm more going to ask a few questions in the beginning because you want to kind of, you have to, you start thinking that that when it comes to fixed income, it feels natural to say that, well, it's all about interest rate, right? We're saying interest rate went up. Oh, well, that was bad for my bond position. Equities, we don't think of that as much. And I believe it has to do with volatility in equities being driven, sure, by some part by the interest rate, but by so many other things that it gets muddled up there. And why is it even relevant to think about duration in equities? And I want us to get into also a few ways to measure duration in equities because it's a pretty fascinating topic. And hopefully we can finally answer the big question that everybody's waiting for here, which is has there been a bubble? Is there a bubble? Has it burst? And what to look for to understand that. But Tony, why don't you give us more color on the little bit trickier question in my mind, which has to do with equity duration. How can we understand this in a little bit of a deeper level here?
Yeah, Lotta, you bring out a very interesting topic. As what you have mentioned that apparently in nature, that people when talking about the duration, they suddenly think about the fixed income. However, in theory, that we can also introduce a similar concept as equity duration for equity for companies as well. Well, if we follow similar definition of the bond duration, well, the definition of equity duration can follow the similar principle. Well, we can actually get it is to be the cash flow weighted average time at which like shareholder can receive the cash flow from their investment into a company's equity. Well, because like bond, you receive the coupon. Now, similar in equity investments, that you might receive the dividend from the company, right? However, now if we think about the equity duration, there are some major difference between equity duration versus the bond duration. The number one is in bond duration or in fixed income, you know that the constant cash flow you receive at a specific time. Now, however, for equity is you just do not know pretty much the cash flow that for each individual company of your investment. This is something, the cash flow is unknown. The second is for bond, typically you have a maturity. So you know the end time, how long that you are going to receive the coupon and at what time you will be able to redeem the whole bond, right? Now for equity is you assume the cash flow will be infinite as long as the business is ongoing. Well, that's happened in theory. However, we know in practice that that's not the case. But in theory, that a company should last forever as long as nothing changed, right? Now, the third thing different from the equity duration versus the bond duration is that the discount rate. Now, in bond, in fixed income, we typically just the discount rate will heavily impact just by the interest rate or the interest rate set up by the Federal Reserve or central government. However, in equity duration, the discount rate is not just the interest rate, but the cost of capital. Like people mainly will use the WACC. So within WACC, there's actually two major components. One is the rate from the debt. The second will be the basic cost of the equity. So those are the major difference between the equity duration versus the bond duration. However, in an environment like today, where we actually anticipated the central bank will continue to hike interest rate going forward to combat the inflation, now the equity duration will become very, very interesting topic to discuss. And as you actually point out that we have seen some duration bubble. And I think Rich has a lot of the comment on this. I might just hand over back to you to see how Rich and you would have some comment over the duration bubble pop.
Yeah, I'll hand it over to Rich, and I could just add one thing that you mentioned here when it has to do with cost of equity for a company. Another one measure that I've seen of equity duration is basically it's admittedly a shortcut, but basically just PE. So price over equity. Oh, so price over earnings. Price over earnings. So people are talking about that, like, well, if you're and the logic here for everyone who's it's not so intuitive is that if your value is very high compared to what you are earning today, it's presumed that a lot of what's coming for you in the future is further away, right? So there's a lot to be discounted there. So if you have high price compared to what you're earning today, that's like a high duration one. So you have like these, if we're thinking about the IT companies, like what we often think about the growth companies. And here, I think I certainly recommend for anyone listening to this to go back to our value versus growth conversation, because it really ties into this in terms of thinking about like when is the cash actually coming here? Is it close or is it further away? So that's one way that I've heard people measuring equity. It's important to note, in the context of what you were talking about here. Just because a firm should exist forever doesn't mean that the duration is infinite. Because the first thing you might ask somebody the first time, like, what is the duration of equity? Some people will say infinite number. And it takes a while to wrap your head around why that is actually not the case, and that the range is not as outrageous as you might think, even though it tends to be longer than a lot of the bond contracts that we have. So Rich, go ahead and give any comments on the meandering that we've applied so far, and do hit a little bit more on the bubble situation that you have more insights in.
Well, I think you guys have both touched on a lot of really, really interesting things. I mean, ultimately, everything in finance comes down to cash flows and discount rates, right? And
Yes.
when you talk about PE, Lotta, I mean, what is PE other than a sentiment measure? It's a sentiment measure that speaks about our confidence in those cash flows, right? And so that's exactly what discount rates ultimately are as well. It's not just what are the cash flows going to be, but it's our confidence in being able to get those. And the higher the discount rate we use in the denominator, that's less confidence we have, and the higher the PE. Remember, that's the inverse. The more confidence we're showing, and so there's really is a direct tie into that. But I think with the subject of whether or not we have a duration bubble and whether we're seeing a bubble burst really ties into a lot of things that we've been talking about. You mentioned the value versus growth. We've been talking about central bank policy. We've been talking about inflation, et cetera. One of the other things that we haven't really talked about as much that we saw certainly post the financial crisis was the notion of financial repression, or the idea that because of what we saw with the Basel III Accords or the Solvency II Accords for banks and insurers, the move into high quality liquid assets that would by regulation that the banks and insurers had to move into to kind of couple with what the pension funds had to do in terms of their liability driven investing, was already moving these institutions into sovereign government debt and into longer duration assets. And then you couple that with what we've seen, particularly post-COVID, of central banks directly involved in the marketplace, having more buyers of these duration assets in the fixed income markets, has ultimately squeezed investors into other asset classes and into duration in those other asset classes. And I can maybe show a sign or a picture of that if I kind of bring up, sorry, here, where is it? If I bring up my slide, hopefully you guys can see that. And I think that there's, as usual, there's a lot going on in my slides, but if I look at this, the blue line there is the amount of negative yielding debt in the world. Okay, it's a topic that, if you remember, we were talking about that a great deal back in 2019 and 2020, and no one seems to talk about it anymore. But that was, when we think about it, how much that was negative nominal yielding debt in the world. At one point, it peaked at over $18 trillion. And that number has now fallen down to close to $2 trillion. But that was the bond market, the fixed income market, getting squeezed because of a combination of both financial repression and central bank policy. But then what we see with a lagged effect is those investors that were getting squeezed out of those markets moving into these duration type assets, if you talked about, in other markets. When you were describing, or when Tony was describing what a long duration equity would look like, I mean, those are oftentimes the really high growth, high innovation tech stocks that we all kind of have come to know. And I use the orange line on this graph, not to pick on them, but as a perfect example of that type of company. And that's the ARK Innovation Fund here, or their ETF. But it really is just an aggregation of these high growth, high innovation names. And you saw that the demand for these peaked sometime in early 2021. And now those have kind of come off quite a bit as well. And so what's going on there is, it's not that the regulation has necessarily changed, but what you see in this yellow line, and I have the inverse of this there, is this is the Wuxia shadow Fed funds rate. Now, I didn't use just pure Fed funds rate. I didn't use, I could have used the real interest rates out to 5 or 10 years, et cetera. I've chosen this one because this index is trying to take into account both the central bank policy in terms of interest rates, but also the central bank policy in terms of quantitative easing. And so remember, before we were even getting any rate hikes, and we've only seen one of them so far, we've seen maybe not quantitative tightening, but we've seen the reduction of the amount of the tapering, the reduction in the amount that the central banks are buying. And so we're already seeing some mild tightening of policy, and we're going to continue to see that going forward in terms of both what's expected in rate hikes, but also what's expected in terms of quantitative tightening. And that's not necessarily in this chart of this yellow line, which should be moving a lot lower. And so you see that in both, you see that the fixed income market is leading the way, anticipating this. The highest growth parts of the equity market are following. And then I have on there a purple line, and I wanted to get Tony's thoughts on this because he's our resident expert. And that's the Bloomberg Galaxy Crypto Index. And so when we talk about equities potentially having infinite duration, and as you said correctly, a lot of that they don't really. How should we think about the duration maybe in the crypto market?
And before you go there, I wanted you to, could you just clarify that for people who are not looking at the picture here?
Yeah.
So what we're seeing we're seeing a lot of the ARK fund, for example, as you said, it's an innovation fund. It has a lot of these growth oriented things in it. It has some Bitcoin in it famously, but it's a fund that was launched to be very forward looking and therefore tends to have these kind of longer duration assets. So that's what we have in a longer duration kind of proxy fund. And then we had interest rate to say, not to be confused, we talked about before, real versus nominal interest rate. Here we're just looking at the nominal interest rate. This applies also, by the way, when you're talking about negative yielding debt in the world, that was really high. It's come down in terms of absolute numbers. But that is also a nominal number, right? It doesn't mean that they don't have negative real interest rate, right? So just kind of before you hand over to Tony, just describe a little bit kind of the shape of the things that we're seeing here, because they follow each other pretty well here.
Yeah, sure. And I'm not intentionally trying to pick on ARK Fund at all, because it was by design, like as you exactly said, that they were moving into this, and investors in that ETF would have known that this is what they were looking into. So what I have here, I have 4 different lines, and for those that can't see it, the first line is the amount of negative yielding debt in the world. So this would be as investors, which started to move higher, 2017, 2018, moved sharply higher in 2019, and then peaked in about December of 2020, and has been moving lower ever since over the course of last year, and very sharply then in the end of last year into early this year. Then following that is this ARK Innovation Fund, which didn't really do much. It moved up gradually. Started to move up in 2020 and came off a little bit with COVID, like everything else did, and then moved up considerably over the course of 2020. At one point, I think it was up over 200% for 2020. And since then, it's down about 65% from early 2021 to early 2022. And so it's been a fairly sharp move lower. Overlaying this is another line I have in here, is the yellow line, which is that shadow Fed funds rate I was talking about, which is an attempt to measure the policy of the central bank, combining both interest rate policy as well as quantitative easing policy or quantitative tightening policy. And then the last line I have on there is the Bloomberg Crypto Index, which measures not just Bitcoin but all coins. It's a measure across the entire crypto index, and of course it peaked in late 17, early 18. And then sold off quite a bit, and then it rallied very sharply in 2020. And it's had a lot of volatility in 2021, but its peak didn't come until the end of 2021, and it started to move lower as well. And so that's these patterns have moved and followed each other, all with a bit of a lag, with the fixed income market as usual tending to lead the way, because that is essentially setting the discount rates for all the other markets.
Yeah, I think both Rich and Lotta hit onto a very, very interesting point. And maybe I was, because this is a topic is so broad, and it actually does combine lots of information within that, is as illustrated by the figure that Rich is showing over here. So maybe I just start with what Lotta has just commented about using the PE multiple as a proxy for measuring the equity duration, because what we are talking about here is weighted average time of investors receive the cash flow from their equity investment, right? You can think about the earning, the PE earning itself, the PE multiple within for the company. The earning is one of the capital that a cash flow into the equity investor. And another component will be the dividend, right? Also part of the cash flow into also investor. Sometimes if a company have to pay the interest, there will be an interest payment. This will be the cash flow to that that a company borrow from the investor as well. So if a company does pay the dividend, or it may not pay the dividend, or it does pay dividend. So that's actually we use it to in total to gauge one duration for investor into equity. Well, a company might not have positive earning, right? So in that scenario, that we might not be able to use the PE multiple to gauge the equity duration until the earning become a positive. But in most of the scenario, especially as what we have seen in the ARC fund, right, which consists of mainly about the innovation company, well, deemed to be innovation. When we actually saying that it's innovation companies, what that really means is most of the time within the foreseeable future, we will not see any positive cash flow of operating cash flow, or we don't even see any positive earning from this company, right? In that scenario, from a cash flow point of view, we investor will have to see a prolonged time before they receive the cash flow. That means the duration will be extended and will be very long. They will have a long equity duration comparable to what we are discussing about the bonds in that scenario. But the key interesting point, as what Rich has shown in that photo, is we do see that the equity duration, we do see the index or the price for ARC actually pick at the beginning of 2021, at the end of year 2020, that actually is really tied to multiple things that especially when we see right now this the quantitative easing started to fade off, and people started to talk about the market anticipated the inflation starting at the beginning of year 2021. Now, that's everything would be a factor into what we are talking about the equity duration right now, right here, because we can imagine the ARC fund in total would have a very relatively large equity duration. So in inflation going high environment. Similarly, at the same time, when central bank try to hike interest rate, we will anticipate the price or the valuation from that kind of a high equity duration fund should actually decrease, right? Just by definition or by in theory. And in practice, that also is the case. Now it's as what we have seen now is even by today is by year to date, the ARC still have very negative return versus the S&P 500. It had a very bad performance last year. I think Rich and Lotta, we actually discussed right at the beginning of this year. So many things when we discuss about the value and growth factor. Well, this is very interesting point. Another thing is I want to finally comment on Rich just mentioned about the crypto. Crypto is very special. We just had a discussion webinar about the blockchain and crypto last week, and a lot of questions would be falling into the valuation framework for crypto, right? Apparently, a lot of guest speakers they talk about this. Now, here's similar thing is for crypto. Traditionally, we thought that crypto might not have any cash flow, especially from the case of Bitcoin and Ether. However, we start to see something changing here, especially when people are referring to the NFT and DeFi. And DeFi, in another sense, is more like we can compare it to like personal lending, the lending activity among the retail investors in Destiny. So in that perspective, we do actually start to see some cash flow flowing within different kind of protocol. Now, so this is actually very interesting development within the crypto in the NFT domain. We might not just make a conclusion that the crypto should have infinite duration, right? But this is something is changing, okay? But how's it really depends on the adoption of the NFT and DeFi. I think this is through our seminar webinar. We hope a lot of the financial professionals will start to get into this point. And I think it's a very interesting topic that Rich and Lotta we can later on continue to explore. This is very interesting development, right? I'm seeing right over there.
Yes, I can and jump in and mention that the event that Tony is talking about, it was an event that the society held. It's online, and if you missed it, it's going to be on this YouTube channel about 40 days, as I understand from about when we released this one. So go check it out. It was really good, and you should always be planning ahead by going into all our on our events site and the society's homepage to search on your browser CFA Chicago, and you have to find all the events there that you can participate in. And we're starting to do things in person now, finally as well. I think that one interesting aspect of when we talk about the bubble, I think what we maybe want to touch on is if we talk about assets going down as a result of discount rates coming up, that might not be really seen as a bubble. And the question in my mind is, are they going down more than they actually should by this the virtue of the discount rate? And if so, we're actually talking about a bubble, but a bubble that is correlated with high duration assets, but maybe actually more of a sign of euphoria of future technologies, and they tend to just come together. Like when you see interest rate coming up, that's also when people become more cautious. Any bubbles that are out there tend to pop. It's going to end up correlating with, hey, high duration and interest rates, just like we saw. And as Rich explained about his graph there, it looks pretty good. I wonder kind of if it is actually the relationship that we're trying to tease out here. Is it really a bubble? If it is a bubble, it's not really maybe determined by the interest rate as much as it might look like if we now, when we slice it up in this high, lower duration, we expect it to have an interplay of interest rate. We're seeing that, but maybe it's more bubble behavior and therefore behavior more than interest rate and discount rates and people sitting there with their spreadsheet coming up with their perfect models. I know maybe Rich, you have a...
Well, I think maybe I would suggest that you're a little bit too sanguine and blaming it only on investors. I mean, central banks, of course, actively urged us to move out on the risk curve, right? I think even going back as far as Ben Bernanke was telling us that they wanted to lower real rates even in the negative territory to push people out the risk curve. So maybe the investors were willing participants in this, but they were nudged in that direction via central bank policy. I think on the fixed income side, they were nudged there not just on central bank policy, but also on regulatory policy. It was, as was highlighted, in the book This Time is Different by Rogoff and Reinhardt, and talked about this immediately following the financial crisis. The one thing I would suggest you though is, like, I wanted to, again, I don't want to make this about crypto, but I think to your point, Tony, like as much as there are difference between value and growth stocks, or the differences within the stock market, so that we don't apply a single duration metric to every stock in the market, I think we might want to think about doing that in the crypto market as well, because there are coins that we could use some sort of yield farming to generate some cash flow from them. But there's other coins that really are just a funding vehicle for a venture capital idea. And if we think of stocks, the most innovative stocks being the longest duration, well, venture capital is the most innovative of equity investments and therefore has the longest duration. And if I think of crypto as just another way of funding a startup company, it should have that same sort of duration as a venture capital. And then if I think about something like the Bored Apes Yacht Club, I think there's absolutely no value whatsoever. And that probably has the most extreme duration, yet that price keeps going higher. So I guess maybe I would throw it back to Tony and see what he thinks about the different coins within the crypto universe.
Well, this is very interesting. Okay, so both of you actually now when we're talking about the equity duration and the duration within the crypto space, we really have to come down to the basic theoretical model is when the interest rate does goes higher, and every asset or financial asset with higher duration should decrease in terms of the valuation, right? This is what we have seen right now is when we look at ARK with high equity duration, when we look at the crypto space with initially supposedly infinite duration, right? We see the price, Bitcoin and Ether all dropped heavily just starting from the beginning of this year. when the Federal Central Bank just started tightening their monetary policy. So every this kind of financial assets, we do see their price coming down, not just by certain amount, but by in another sense is heavily, as what Lotta just pointed out. Lotta saying, hey, when we see is it bubble? Now if we do see something on financial asset with the valuation that went down like more than 50%, we can actually, and we can tell from the backward looking, definitely there was a bubble within that, right? If it's something that went down 50% and it's still don't call it a bubble, definitely there's nothing else that we can call it a bubble. Apparently, we do see a bubble in crypto space and in some long equity fund like ARK in the past few months or past two years. Apparently, we can make such kind of conclusion, right? But now actually the more interesting question will be like going forward, is the bubble end, right? Will they find a bottom right here, which means whether price goes higher from now on or just keep going lower. Now this is actually whether the bubble will continue to pop. That's also a very interesting question. As what Richard just pointed out, we're looking at the crypto within the NFT, especially talking about that Ball app. This is a very, I would say maybe someone called it innovation, and someone called it lie or hoax or fraud within the financial investment community, right? Now, it really come down to the point whether there might be some utility. Well, people do find some NFT or DeFi have some utility, which we all agree. Some crypto do have some utility function, which means they are very helpful in terms of facilitating the adoption or helping to raise the operational efficiency of financial transaction across the board. Or sometimes like app, if they're gonna show you as a symbol as of NFT for you to own the digital right in this kind of what they call the digital era, with everything will be transferred, will be minted from the physical universe into a virtual universe in metaverse in another sense, right? Now, actually, I think lots of financial theory would have to be modified to determine, well, would that be actually something what we call the infinite accurate duration of in the traditional financial asset? Would that be still appropriate measure in terms of the valuation? Valuation of the crypto is very, very right now controversial. People would like to use what they call a network effect as one major factor to determine the valuation of the crypto. Well, the network effect is something that what we have seen in the shared platform like Facebook, right? We have a social media that we have two sides, one user side and merchant side. This is people will come together. Now here, network effect has nothing to do with the cash flow, which is basically still saying that in the crypto space, we might continue to anticipate an infinite duration. And however, should we actually still using the infinite duration, which means 1% change of the interest rate, which you see the valuation from this crypto went down from certain value to zero immediately, right? If it does, however, that probably might not be the case. This is even though this is interesting to look into the valuation of the crypto with relative to the traditional financial asset like duration. However, this is a lot of complicated factors in determining over there. But definitely we will continue to look into this two space very closely. However, regardless, those kind of assets with high duration or long duration will suffer within this high interest rate environment.
Yeah, it does make the point that you tend to have more variation in the prices of higher duration assets, because if you change your interest rate outlook, it's going to affect their prices more. And it's really, really important thing that you're pointing out, that just because your model said that if you change your discount rate, the price change, doesn't mean it's not a bubble. If your discount rate was wrong, if you're changing your discount rate in infinity, you had it at, you had it at 0, and now you're increasing it to 3, and lo and behold, your price falls by 90%, and everybody follow that, right? Like, it's still a bubble. It doesn't matter that it was a change in the input, and like the way that I was kind of approaching it before. So I hope that our audience have gotten a lot of just thought-provoking inspiration here of how to think about this, and whether we are in a bubble, because in a way, like, it really is, it's a little bit of a matter of perspective. But as Tony kind of alluded to here, like, it does boil down to price. If you thought the price was like 90% higher than it is now, maybe it was a bubble. But it also, hits it from the other side of like, well, maybe if you're now changing your discount rate to 5% in infinity, maybe that's a bit high to think of, if you say like a real discount rate in that time span. We should wrap it up here. Any final thoughts for any of you that you want to make sure our audience leaves this conversation with?
I would just throw out there that, like I said before, finance is always about cash flows and discount rates. And even crypto, if it is finance, is about cash flows and discount rates. And so I acknowledge the network effects comment, but network effects are just about future cash flows. There may be no current cash flows, but they're about future cash flows. And so therefore, to the extent that those cash flows are too far in the future, they're going to be affected in a higher interest rate environment.
Well said.
Yes, the valuation framework within the traditional financial domain and in crypto domains, the most critical issue that a lot of financial professionals are pursued. And as long as we can discover something, maybe an ingredient, people may have an edge in terms of creating the return for the investors, right? This is always very important. But as what we have discussed today now is in the interest rate hiking environment, especially what we are going to see is the monetary policy adopted by the central bank in early May. Will they hike 50 basis point, or they hike 75 basis point? This is going to lead to the further reaction from the market in both equity market, bond market, and crypto market. This is something I think we will continue to monitor and discuss maybe in a few weeks.
Yeah, you might have just set us up for the next conversation in 2 weeks, Tony.
I think that's very, very critical and very important, right? This is to set up a great tone in May, early May. We're going to see I think they're going to release the monetary policy from the FOMC meeting very soon.
A lot of things to look forward to. Thank you so much, guys, for joining me today.
Thanks, Lotta. Thanks, Tony.
Thank you, Lotta. Thank you, Rich.
And thank everyone for listening.
Yeah.